Hello, I'm delighted to have with me today Caprite's Jonathan Rivera. Thanks for coming in again, Jonathan, and sharing your insights into the multifamily sector.
Thanks, Steve. Glad to be here, and welcome to Chicago.
Oh, well, thank you. It's good to be here. Well, we've almost reached the midpoint of 2024. What a good time for you to update us again on the performance of the multifamily market compared to the previous 6 months.
Yeah, overall, nationally, the multifamily market is doing pretty well. There are some markets that are performing better than others, however. So over the past few months, we've seen really good improvement and really good strength in the Chicago apartment, for example, whereas Sunbelt markets are lagging mostly due to oversupply. Coastal markets are relatively stable, with the East Coast doing a little bit better than the West Coast.
Yeah, so there are some regional differences as we lead up to the election in November.
Yes, definitely.
And what does this mean in terms of risk and return for investors in this sector?
Yeah, markets where you are seeing growth, there's obviously better return on investment than the markets that are more oversupplied, and that's kind of where the risks are right now. It's in markets that are oversupplied. So there are some near-term risks where you have a tremendous amount of new supply that's come on the market that still needs to be absorbed, and their projections for rent growth are pretty anemic in those particular markets, and that's kind of where the risks are currently. And then all the risks obviously include insurance. Chicago has a particular risk with real estate taxes, and obviously the insurance risks are spread out throughout the country, but they're most prominent, in coastal markets, West Coast, as well as a little bit in some of the Sunbelt markets.
Yeah, well, you haven't mentioned the big elephant, which is high interest rates and the cost of capital.
Yeah.
Tell us how that's affecting the market.
Yeah, like most real estate sectors, the cost of capital has negatively affected the investment market in apartments. We've seen, pretty tremendous decreases in values. When transactions do occur, they're often below replacement cost or at replacement cost. So, the higher interest rates have made a pretty big impact on the investment market. Overall.
Well, isn't it always the case with poor performing properties? They lose their value very quickly and get stuck on the market.
Yeah, that is true. And with apartments, it's not like office where you have a lot of poor performing properties. But in multifamily, the handful of properties where it's poor performing or highly oversupplied, you're going to obviously see the higher decreases in values. But there are a lot of opportunities for buyers too, because buyers who are able to kind of drive pricing now are able to jump into the market and acquire properties at values below replacement cost, which is pretty extraordinary if you think about long-term trends.
Sure, that's a unique facet of the multifamily market, I think, because the bid-ask spread in other sectors has just got wider.
Yes, and it's narrowed more in the multifamily market as properties become more attractive when they get close or below replacement cost.
Yeah, I'm going to throw you a curveball.
Of course.
We talk a lot about the mobility of Gen Z and millennials. Is that mobility affecting the market? Has the market adapted to accommodate these cohorts in different places? Yes,
so there are a lot of things going on there with the mobility of Gen Z. A lot of it has to do with housing affordability.
Yeah,
and the price of buying a home is so much more than it used to be for many factors, partially interest rates again with mortgages, and then the fact that there's just not a lot of supply out there to buy anything. Really, after the great financial crisis of 2009, there's just not enough homes were constructed. So there's supply issues, mortgage rates, and so culturally, Gen Z is just more mobile because of that. They also have a lot of overhang of student debt as well. So that said, that's been a benefit, frankly, to apartments because a lot of these maybe potential buyers of homes are remaining as renters.
Yeah.
And so because of that, you're seeing apartments with smaller average unit sizes, more efficient, larger common areas to help with work remote, so that tenants can work remotely in work spaces and common amenities. And so the whole apartment experience has changed quite a bit to accommodate these more mobile tenants.
I'm fascinated, and I won't ask you more than
Yeah.
that, but real estate has to adapt as society changes, and what you're saying is multifamily has really started to adapt.
Absolutely,
Yeah.
yeah, absolutely, like
Okay, well,
other sectors. Yeah.
Not to cut you off, but
No,
what
no
about
problem.
the future? Look in your crystal ball.
Yeah.
What do you see? Continued strength in this sector?
Yeah, so on the market level, right now we're seeing a slowdown of apartments, except for certain markets like Chicago, until the new inventory is absorbed. However, medium term, the prospects for apartments are quite positive. We just don't have enough housing in this country.
Sure.
And with continued demographic population increases, we're going to see a continued demand for apartments going throughout the next 5 to 10 years. Investment side, a lot depends on interest rates, of course. It looks like the Fed will probably start to bring down the federal funds rate this year, which could help spur investment activity. But like I was saying, investment activity has already started to increase slightly with apartments because you're running up against that replacement cost threshold.
Yeah. Well, we've all become Fed watchers, I think, by nature.
Certainly.
But thanks for coming in today
Yeah.
to sharing that view.
Of course.
And we'll look forward to seeing how the market unfolds when we talk again.
Great. Thank you. I enjoyed it.
Thank you, Jonathan.
Thanks, Steve.